Fundamental analysis is a method of evaluating the intrinsic value of an asset, such as a stock or a company, by analyzing its financial and economic data. One of the key ratios used in fundamental analysis is the price-to-earnings (PE) ratio. Definition of PE ratio. The PE ratio is a financial metric that compares the current market price of a stock to its earnings per share (EPS). It is calculated by dividing the market price of the stock by its EPS. The ratio provides an indication of how much investors are willing to pay for each dollar of earnings generated by the company. Formula for PE ratio. PE ratio equals market price per share / earnings per share. Example. Suppose a company has a market price per share of $50 and an earnings per share of $5. The PE ratio for this company would be calculated as follows. PE ratio equals $50 / $5 equals 10. This means that investors are willing to pay $10 for each dollar of earnings generated by the company. A high PE ratio may indicate that the market has high expectations for the company's future earnings growth, while a low PE ratio may indicate undervaluation or lack of growth prospects. Warren Buffett, one of the most successful investors in history, has a unique perspective on the stock market and what makes a company valuable. In this video, he shares his insights on why some companies have higher PE ratios than others. By understanding his approach to evaluating companies, you can gain valuable knowledge that can help you make informed investment decisions.
What makes a company's price-earnings ratio move up relative to other companies in its industry? How can we, as investors, find company and even industries that will grow their relative price-earnings ratios as well as their earnings? And thank you for the wonderful weekend and for sharing your brilliance with the shareholders.
Oh, thank you.
Thank you.
It's very simple that relative price-earnings ratios move up because people expect either the industry or the company's prospects to be better relative to all other securities than they have been than their preceding view, and that can turn out to be justified or otherwise. Absolute price-earnings ratios move up in respect to the earning power or the prospective earning power that is viewed by the investing public of future returns on equity, and also in response to changes in interest rates. And in the recent, well, really ever since 1982, but accentuated in recent years, you've had decreasing interest rates pushing up stocks in aggregate, and you've had an increase in corporate profits. Return on equity of American businesses improved dramatically recently, and that also, and people are starting to believe it. So that has pushed up absolute price-earnings ratios. And then within that universe of all stocks, when people get more enthusiastic about a specific business or a specific industry, they will push up the relative PE ratio for that stock or industry. Charlie, you've got anything?
Yes, I think he also asked, how do you forecast these improvements in price-earnings ratios?
That's your part of the question.
Around here, I would say that if our predictions have been a little better than other people's, it's because we tried to make fewer of them.